I appreciate everybody coming back after last night. I didn't know if I was going to make it back, that's for sure. Still married, although her last words last night before going to bed was, "You owe me." This morning when I woke up, said, "Hon, will you drop me off up at the Dixie Center?" She said, "You owe me." So I don't know what it'll be, but nonetheless, we may not see her next year at the Plumbers Conference. Appreciate y'all being here. My last name's Hunt. I love to hunt. I grew up here in St. George, so this is home for me. This is where I went to high school. I've got family down here, and so it's great to come back home, spend time with family. We went over and saw my brother out in Bloomington. He is the CFO of the casino group down in Mesquite, and love it down here. My family up north is all plumbers. Some of you know that. And so this conference is near and dear to my heart. They're the union side of things, so yeah, they're the other guys. But nonetheless, I grew up in a plumbing family, in a plumbing business. That said, I personally believe that you are the most underpaid group on the planet. And I really believe that. I think you deserve more than what you get paid. That said, I think you hold each other back from being paid more. And that's kind of a weird concept, and we'll talk a little bit about it. But if there ever was a time for you to make more money, it's today. And I'm going to talk about some of the financial tools that you can look at to help analyze and make more money in your business. Granted, you're in a bid situation. Lowest bid usually wins. And we're cheap. Utah is a cheap state, so doing business here in Utah is difficult because generals, owners, they want cheapest. They may not want best. They don't value your work. And it all gets down to how quickly and how cheaply can you do it. And that's not a good business environment. And somewhere along the line that's got to change, and we'll talk a little bit about that. But if there ever was a time for you to make more money, i.e. raise your prices and push back a little bit, it's right now. There's enough work and enough good jobs out there for everybody to find your niche and be able to make money. Let's switch gears here. Take down my little bragging picture. That was just up the road, by the way, if anybody needs to know that. Pine Valley Mountain. Let's go here. All right, here we go. Some of you have already heard a little bit of a discussion about tax reform and what that means to construction and to you guys. I want to share a little bit of insight on really, truly 3 or 4 items that you need to be aware of and take into account today. Many of you have turned in your information to your CPA and said, okay, crank out my returns for 2017, and so that's about as far as you really care about tax reform. There are provisions in the tax law and that new tax reform that revert to 2017. You need to be aware of that. And when is the best time to do tax planning for 2018? Right now. So if you don't understand tax reform and you don't understand the tax laws for 2018, how can you be doing tax planning for 2018? So I'm going to highlight a couple of things that you need to be aware of as you plan for this year that you're already partially into, and be able to say, hey, let's be effective when it comes to taxes as we plan and not wait till year end. So with regards to tax reform, we're going to touch on that just briefly. Then we're going to dive into understanding your financial statements and what makes up your financial statements. And we're going to do a high level, and then we're going to dig in deep. And we're going to talk about a few things. I'm going to share a few concepts with regards to job costing, direct costs, indirect costs, and allocating certain indirect costs to job costs and how that affects your financial statements. Troy DeLuca is going to talk after I do for a little bit, and he's going to talk about what a bonding company looks at on your financial statements and in your WIP schedule. You can manipulate your income for financial statement purposes and for tax purposes based on how you account for things. There is some wiggle room, and hopefully you guys understand that, and you're working with a CPA that gets that. I'm with the firm CliftonLarsenAllen. 80-90% of my clients are our firm's clients are construction contractors. Our office is in Salt Lake, and we have an office in Vegas, and I spend some time down there as well. We're going to talk about job schedules, need for healthy financials, and then we're going to circle back and say, what are really the keys to making money in this business? And I think the key element is labor. That is the true variable cost in your business. It's the hardest piece to estimate. How long is it going to take you to do this job? How many man hours is it going to take you to do this job? That is the variable cost. If the job takes too long, guess what? You don't make as much money. If you can get in, get out, and be prudent about managing your people, you will make money. So we'll talk a little bit about that and circle back on that. Tax reform, what happened? The biggest key is that the tax rates changed. From 2017 to 2018, rates went down for the most part. There was one little group that the rate went up from 33% to 35%. So if your adjusted gross income was in this range, you have a slight increase in your rate. But by and large, for most people, your tax rate went down. For a lot of clients that I deal with, they end up being in this, $237,000 to $400,000 range. You went from 33% down to 24%. That's a huge difference. So from a tax planning perspective, I was meeting with all of my clients back in November and others and speaking at forums like this saying, if there ever was a time to defer income, if there ever was a time to buy more equipment and manage your income, it was this year. Because you get a permanent savings by pushing that income into 2018, just on that rate differential. Okay, so that's one key. Rates changed. So take advantage of that rate change. Know where you're at and how to manage that tax rate. Okay, the equipment deduction. This is where it took effect September 27th of 2017. You guys have heard about bonus depreciation, right? Bonus depreciation, you can do bonus depreciation and take 50% on a new piece of equipment and then depreciate the remaining life of that, the other 50%, over a 5-year period. Congress inserted this provision that said we're going to go to 100% bonus depreciation. And under the old law, it had to be new as in first use, not new as in new to you. So if you bought a used piece of equipment, that's not new, right? So it's new as in first use. Well, under the new law, it's new or used, and you get 100% bonus depreciation, and there's no limit on that. Okay? This is huge. So if you bought assets like everybody did right at the end of last year, you could use what's called Section 179 and expense that, or you can use this provision and expense it as well. There's no cap or no limit to this provision. So if you're a large company with a large amount of equipment and you bought $2-3 million worth of equipment at the end of last year, you would have been limited under Section 179 on how much you can expense. And then you would have had to use bonus depreciation for the 50%. Under this provision, going back as long as you purchase it after September 27th, on or after September 27th, you can elect to expense the whole thing. We do have a client that bought something on September 26th, about a $500,000 piece of equipment. And they've gone back to their supplier to see if they could re-invoice that to get it to be September 27th, just because of this single provision here. Okay? That does change and phase out over time in the future years. It'll go to an 80% bonus to a 60% bonus, and then it'll phase out in 2026. But for the next several years, we've got 100%. Okay, the question was, will I share the slide presentation? Absolutely. Okay.
Otherwise, I'll take a picture.
No, please don't. I'll send it to you. No worries. Okay, Section 179, under the old law, the phase-out point was $510,000. If you bought more than $510,000 worth of equipment, you can only expense up to $510,000 as long as you bought $2 million or less in total equipment. You buy over $2 million, you lose out on that. Starts to phase out after $2 million. They raised the limit to $1 million. So I have clients, contractor clients, that every year plan around spending $500,000 in equipment every year. Now they're up to $1 million, which is a great thing, because depreciation is the single biggest friend you have in your business, I believe, because of what you do. Especially excavation companies, especially heavy equipment, capital intensive type businesses. Plumbing, not so much, not a lot of equipment, but some of you guys have gone to that prefab model where you're buying and actually having a fab shop in the back and doing a lot of prefab. You're buying some pretty expensive equipment to help with that. This is your friend. And the reason is because the deduction doesn't match the cash flow. Does that make sense? Depreciation, you get a deduction for depreciation without having to expend the cash today. If you finance that piece of equipment over the next 5, 10 years, you still get 100% deduction today. So it's a tax deferral methodology. Okay, here I think is the biggest area that well, there's two. This one right here, we used to get in construction the 9% D-pad. I hope everybody in here took advantage of that. And I've presented multiple times over the last 5, 6 years on this specific deduction that I believe was created just for contractors. But it was a 9% deduction on your net income. If you want to know if you took that deduction, go home, pull out your tax returns from last year, look at line 35 of your 1040, and see if there's a number there. If there's no number there, you weren't taking the D-pad, which means you missed out. Now you can go back and amend those returns, and we've worked with clients over the years. You can go back 3 years and amend returns to take the D-pad. Line 35 on your personal 1040, assuming you're a flow-through, pass-through entity. Okay? What Congress did is they said, and this was related to construction companies, not service. And I know some of you do service or do a lot of service in the plumbing business or have a division that does a lot of service. So you have to bifurcate your construction side from just pure service. You only get the D-pad on the net income from the construction side of the house. Okay? Now, the new deduction for 2018 and going forward is this 20% deduction. And we call it QPI, but it's the 20% deduction of your net income from all activities. So it's not limited to just construction, it's construction and service related income. That's huge. So in effect, it takes your tax rate from, say, the highest tax bracket of 37, you're going to get a 20% deduction off of that, brings your tax rate down to 30, 29 roughly, right? With restrictions, the 20% QBI deduction is limited to wages. So if you operate as a Schedule C business, you need to look at that because you're not paying yourself wages in a Schedule C business. You may be paying some employees, that's going to help you, but you may need to look at your entity structure in order to take advantage of this 20% deduction. If you're an S-Corp, you've got flow-through, fine, that's great. If you're a partnership or an LLC being taxed as a partnership, you need to look at that and say, are we paying wages? This limitation or this exception with regards to wages is huge. Many of you have structured your company into multiple entities, right? You have an operating company that does the plumbing business. You have a real estate holding company over here that owns the property that the business sits on, and you lease that to your operating company. Pretty standard structure. Some of you may even have an equipment company that leases the equipment to the operating company as well. These are all common structures that I see. The problem is you're only going to get this 20% deduction if you have wages in the business, for the most part. If you have a real estate holding company over here that's leasing the building back to the operating business and that real estate company has income, you will not get that 20% deduction. So you're going to have to relook at your rents that you're paying and try to basically zero out that side of the house so that there's no income. You have more income, say, in the operating company. For financial statement purposes, that usually gets collapsed and reported on a combined basis. But in this context, that QBI, that 20% deduction, you need to look at your structure and say, are we maximizing that? And not wait till the end of the year. Because this is based on wages, and when do you need to start paying wages? Probably a little bit earlier on in the year in order to try to get some wages there. So you need to pay yourself wages in a real estate holding company or an equipment company, or pay your kids or somebody some wages to do something in that entity so you can get wages there to get this 20% deduction. Does that make sense? Okay. Oh, they screwed accountants, by the way, when they did this law. Accountants don't get that 20% deduction. They specifically carved out and said accountants, attorneys, and a bunch of others don't get this deduction. So it's not fair, and we don't have as big a lobbying group as you guys do. That's basically what it boils down to, I think. All right, this is another big one. Okay, under the old law, once you hit $5 million as in revenue on an average of the last 3 years, you had to go from cash basis to accrual basis. And many contractors go from, once they hit the accrual basis, go to what's called completed contract method. So if you're in that $5 to $10 million revenue range, typically you're on a completed contract method. Some of you still have the ability to be on a cash basis method under the right scenario. But once you hit that $10 million mark, what happens in revenue? You have to switch again how you report your income for tax purposes. This is a tax-only provision. So for tax purposes, once you hit that $10 million, you've got to go to what's called percent complete. And I think most of you are familiar with what percent complete is. That's how your financial statements are prepared. That's where you have a WIP schedule and you evaluate your over and under billings. So that way you determine based on cost how far along you're complete on that job and recognize profit based on how complete you are. The new law basically says we're going to raise that threshold to $25 million. So I know my family business operates in that $10 to $18 million range. They've been on that percent complete method for tax, meaning they've been paying tax on how far along the building or the job is. On a cash basis, you only pay tax on the cash that you receive. You get a deduction for the cash that you spend. The cash basis of accounting is the most basic method of accounting, but it's also typically the most advantageous method of accounting. So if you're in that anywhere between $5 and $25 million range in revenue, you need to be on the cash basis. You need to be speaking with your accountant right now to make the elections, put this in place, and make sure that you qualify for it in advance so that you can be on a cash basis. Does that make sense? Any questions on that provision?
Is that for just 2018 or is it 2017?
2018 and forward. So years beginning on or after January or December 31st. Yeah, on or after January 1st, 2018 is the actual law. So it'll happen this year. So make that election this year. Make sure that happens early on in the year so that the IRS accepts it. And what will happen is you're going to have what's called a 481A adjustment when you convert from the percent complete method to the cash basis method. Basically, you take your financials for tax, you calculate what your balance sheet looks like under the percent complete method, you calculate what your balance sheet looks like under the cash basis method, and you will come up with a difference. That net adjustment you then spread over 3 years, 3 to 4 years, depending on positive or negative adjustment. So you're going to take that benefit into account over the next few years when you make that conversion. Converting from a percent complete basis to a cash basis will generally create a positive net deduction. So therefore, you're going to take that into account. You're going to get an additional deduction spread over the next 3 or 4 years. Okay? It's a huge deal. All right. Effective record keeping. We're going to skip right straight to this section right here. Okay? We all know what a balance sheet looks like. How many of you guys pressed print on your QuickBooks so that you can print out your balance sheet and give it to your accountant so they can do your taxes? How many of you, the only time you look at the balance sheet is when you press print and give that to your accountant? Once a year, right? How many of you review your balance sheet on a regular basis? Okay? I think you should. I encourage you to look at your balance sheet. I look at the balance sheet. When I'm evaluating a company or a new client and they're saying, how well am I doing? That's what I look at, is that balance sheet. And it's not just looking at one number, which is cash. How much cash do I have in the bank? If I got cash in the bank, life is good, right? We're not just looking to say how much money I got in the bank on a balance sheet. It tells a story. It tells a story of how much in the assets that you own versus the liabilities or people that you owe. It also tells you how much equity or skin you have left in the game. So let's talk a little bit about this. This is a general this example is a general contractor, so I apologize if the numbers are skewed for most plumbers. But in this example, you have cash at $5 million. You've got this item right here, cost and estimated gross profit in excess of billings. We're going to talk a little bit about that. That comes off of your WIP schedule. And that basically, everybody should be operating or attempt to be operating in an overbilled situation. Okay? Sometimes tough to do. You start the job today, you start work today, how soon before you get paid on a job? 90 days? Okay? Pretty standard. It's usually 60, 90, even sometimes 120. 90 is if you're lucky and you've got all the paperwork filled out correctly. If you miss one schedule, they send it back to you and you're not going to get into till next month's billing cycle, right? Some of these generals push back quite a bit on that. So if you're self-funding this basically for 90 days, you need to figure out a way to get ahead of the game, because those costs that you're incurring for payroll and materials and other items on that job that you're incurring today are coming out of your pocket. They're coming out of the profit from prior jobs. You're self-funding that. So to the extent that you can, you want to be in an overbilled situation on all of your jobs and work to get to that level. Okay? Liabilities, those are the loans and debts that we have. Accounts payable would be the current liabilities that we have there. And then you have down at the bottom, this one's actually a C corporation, this example, but the bottom is your equity or your skin in the game. Okay, let's talk real world for a minute. What do most contractors do when they make a lot of money or they have a good job and it's profitable and you got money in the bank? You spend it. You guys are awesome at buying stuff. Seriously. I love working with contractors because they all have boats, Can-Ams, cabins. And if you take your accountant, it's tax deductible, right? It's the best. You guys buy stuff. Some of you buy real estate, and so you basically convert that cash into an income-producing asset over time and pull it out of the business and put it into real estate. But when you pull the cash out of the business, what happens to your financial statement? It affects it, right? It affects your lending capacity, your bonding capacity, and other factors. So you've got to take that into account as you pull money off the table. Well, one of the reasons why you pull money off the table, I believe, is because that money sitting there in the company is at risk, right? And you have risk in your business. You have risk in what you do. And if that money is an asset sitting in the bank, that's at risk potentially to creditors and other people, or job defect, whatever. They can go after that. So most contractors try to pull that money off the table, and I get it. My clients try to do that all the time, and I encourage them to. Because as a contractor, and I don't mean this in an offensive way, you are only as good as your next job. And I hope you understand that. Just because you did a good job yesterday doesn't mean you're going to get any more work. Is there a guarantee in this business? How about you guys on stud row? Is there a guarantee that if you do a good job yesterday, you got work coming out the yin-yang going forward? No. Okay? I call that stud row, by the way, back row. And there's a reason for that. Back when I was speaking to a bunch of Ford truck dealers. Okay, I'm derailing, so you can, if you want to stop the cameras, you can, because I tend to do this when I'm up here. I was presenting to a bunch of Ford dealers, Ford truck, and they were talking about, they wanted to know about depreciation. There's about 130 of them in the room. And this was in California, so they had the Larry H. Miller equivalent in California in the back, and his little posse. They had, stud row back there. And I'm up here presenting, and I'm talking, giving out information, and they wanted everybody, the one guy wanted everybody in the room to know that he was there and that he knew more than them. So he asked one of those let's stump the presenter questions, which tend to happen every now and again. And I knew the answer, but I wanted to be very specific in how I responded because it was a technical question and I wanted to portray that I knew my stuff. So he asked this question, and I go and I referred to my notes. And I'm going to move. Sorry, I'm going to go off camera. You may have to move. But I was up front like this, and I was presenting, and I was flipping through the pages on my notes to get the answer. And I had one of those handheld mics rather than this kind of mic. And I was looking or flipping through, and I went to lick my fingers because the pages were slick, and I brought up the wrong hand. And I licked the microphone. And I just kept my head down, kept flipping, hoping nobody noticed, and I was about as red as I was last night when I was up on stage. And I looked up to give the answer, and the guy right here says, "Did it taste good?" So every time I see it, it's always, the cool guys sit at the back. That's just how it is. So that's my reference to stud row. What do I look at in a balance sheet? What do bonding companies look at in a balance sheet? What do banks look at in a balance sheet? Retained earnings, right? What is that equivalent to? What's that? How much you saved? Is that what you keep in your business? I call that your skin in your game, right? The skin in the game. That's how much skin in the game you have is your equity section or your retained earnings. That's how much profit you're basically leaving in the business and carrying forward to sustain the business. A healthy amount of retained earnings is important for you to have bonding and lending capacity. Okay? What else do we look at? I look at this. Your current assets, which current assets here is $24 million roughly, versus your current liabilities. Current liabilities is $17.7 million. Current assets versus current liabilities. That's called your current ratio, or sometimes referred to as your working capital ratio. Current assets are items that are going to become cash or cash equivalent within the next 12 months. That includes cash in the bank, securities and investments that are readily available to you, as well as your receivables. Current liabilities are your debts that you're going to have to pay in the next 12 months. So you've got to have enough money in the bank or coming in the next 12 months to pay your bills for the next 12 months. And the tighter that number gets to each other, the more difficult it is to bond, the more difficult it is to get a loan. They want to make sure that you have the ability to pay your bills currently. So what happens? Okay, let's use an example here. You've had a great year, and you've got to go buy equipment because you're at the end of the year and your accountant says, we need an expense, we need a deduction. And some of you are Dave Ramsey fans, and I'm telling you, Dave Ramsey's good, but doesn't always translate to good business. You take your cash off the table and you go out and you buy a truck. And it's not just any truck, it's a cool truck. It's a GMC Denali HD, lifted, big tires, all the extras, bells, whistles you can think of, and you walk out the door with a bill for $110,000, and you paid cash. What does that do to your working capital ratio? Does it affect it? Some people think, well, I just went asset for asset, right? I took cash and I bought a truck. Both of those are assets. It doesn't make a difference. It does. And the reason is because your fixed assets are a below-the-line item. They're a long-term asset, not a short-term asset or a current asset. So you took a current asset, traded it in for a long-term asset. That affects your current ratio. That affects your borrowing capacity. Now, banks sometimes do look at your assets and equipment, and they give you credit back for the equipment that you own, and if you own it outright. So there is a little bit of a factor there. But be careful. Remember that cash is king. You can't pay your bills for that next job that you get. Remember how you're only as good as that next job? When you get that next job and you're ready to start it up, and you drive on the lot or drive on the property with a brand new truck, does that brand new truck pay the bills? No. Does it buy the supplies and materials that you need for that job? No. You need that cash. So preserve your cash to the extent possible because you need that to fund growth. If you're in a growth phase, where do you get the money to fund that? Sometimes banks will give you a line of credit, but for the most part, you're self-funding that from prior profits on other jobs. Okay? Let's go over to income statement. And we're going to spend quite a bit of time now on the income statement and the related schedules to the income statement. What do most people look at when they look at an income statement? The bottom line, right? How much money did I make? Right here. Right there, net income, $1.9 million. Can you guys see that? It's kind of light, and the light's a little blurry? A little blurry. All right. Oh, well. It's a good slide. It's pretty. $1.9 million bottom line on, again, this is a general contractor, on $85 million in revenue. Most people go straight to the bottom line. For financial statement purposes, when you push print on QuickBooks, that's an accrual basis net income. Then you can go and click a box and it'll print out a cash basis income statement that may or may not be correct. But it doesn't necessarily give you the full picture because as a contractor doing long-term contracts, you need to adjust for that percentage of completion method or that percentage of completion, the percentage of completion for GAAP, financial purposes, as well as tax purposes in a lot of cases. And what I mean by that is if you're in an overbilled situation, remember how we talked about that. Everybody should be in an overbilled situation where you're ahead on your billings. If you're in an overbilled situation, you have to then back that overbillings off of your income statement to get to a true net income. Because on an accrual basis of accounting, you record income when you bill it. And if you've overbilled it on a percent complete basis, then you've over-recognized income or over-recognized revenue, which then results in an over-recognized income situation. Okay? So that's what that percent complete does, is backs that off, that over and under billings, off of your income statement. What do I look at? Okay? What do I look at on an income statement? I go to basically, the first number I go to is this number right here, which is this income let's see, gross profit from contracting, that line right there. It's basically your revenues minus your cost of goods sold. And in your scenario, your cost of goods sold generally is made up of materials and labor, right? In this case, you've got labor and you've got some subcontractors, you've got some equipment costs, rental equipment, that kind of stuff, and other. But that goes into your contract costs. What does this number represent right here? This $3.8 million. Gross profit from contracting. You making any money on the work that you're doing? That's your direct, that's kind of your operating income, right? Or your gross margin. I look at that number and I look at your revenue and I usually do a percentage and say, what percentage of this number is this number? As a plumbing contractor, what should that number be, or what should that percentage be? 15 or something, right? Here's what I heard. I heard a 15%. 15%. Okay. My personal belief is you need to be in that 20 to 25% range. Yeah. That's a good point. If you're doing construction versus service, you could have a different number there. But generally speaking, the target for subcontractors, specialty trade contractors, needs to be in that 20 to 25% range. What's that? He's a general contractor, so all they do is they basically put people on the job to say hi and make sure you guys are working and get paid for it, right? That's what general contractors do. They show up, drink their coffee, make sure you showed up, and then they drive away and get paid for it. So 5%, yeah. And in this case, it's a little bit less than that, but right around that 5% target for a general contractor on that gross margin. But again, for you guys, it needs to be in that 20 to 25% range. Electrical contractors, tile contractors, plumbing and heating contractors, you're all in that key sub. You should be making money in that range. And you should bid your jobs to make money in that range. Part of the problem is that 15% number needs to be when you come down after your G&A expenses. You need to be in that 10 to 15% number. Does that make sense? Okay, so I remember having this discussion with my grandpa. And I talked to my grandpa about break-even analysis. I talked to him about, how you make money. And Grandpa didn't necessarily look at financial statements to do his analysis. He just knew because he'd been doing it for so long. Some of you, I do believe this, there's some truth to this. Contractors have an instinct. You have a gut. I actually met with a $30 million electrical contractor that bids off of their gut. Crazy. I said, dude, there's software you can buy, and you do your takeoffs, and you do all your analysis, and you can buy the software, plug the numbers in, and it'll print out where you should be on this job if you adjust for percentages and how much money you want to make on it. He said, yeah, we do that, but then we have to go off of gut. If this is a good job, then we'll maybe bid a little bit less, or however much money we want to make. If we need work right now, then I'll bid a little bit less, but for the most part, I bid off my gut. Crazy. But I do believe there's some truth to that, and I do believe that you guys have a talent as well as a gift to be able to bid and do work off of instinct. But be careful, because occasionally I know with my gut, it gets upset, and that turns out bad, right? Don't always do everything off of your gut, because sometimes that may not turn out as planned. Grandpa's gut said, okay, in order for us to break even, we need to do $8 million worth of business. He knew that his fixed costs were at about $800,000 to $1 million. That overhead cost was about to run the office, to have an office, to have space was about $800,000 to $1 million. And he said, in order for us to make money and hit that target, we have to do $8 million of revenue. Anything over $8 million, we're making money. So he tried to push and operate in that $10 to $12 million range. And that was kind of that sweet spot, if you will. At that sweet spot, he could make $1 million and be happy, and life was good. That was how he thought, and that was how he managed the business and managed the numbers. It plays out in this same type of scenario. If you take the percentages at 20% and roughly 10% for overhead, your net income is going to be in that 10% range. Do you know your break even? As a business owner, do you know how much money you need to make in 2018 right now in order to cover your fixed costs? Do you? It's a question. I hope so. I really, truly hope you know what you need to produce on an annual basis and on a monthly basis in order to break even in this business, and that you manage your business from that context. A break-even analysis would be very simple to do. You're going to say, okay, what are my fixed costs, which is generally this general and administrative expenses here, as a number over the last several years, as well as a percentage of my revenue. Do a 3-year average. And say, okay, based on that, these are my fixed set general and administrative costs, office expenses, etc. That's the nut that I've got to reach or attain every year. Okay? Then you've got to say, okay, where do we want to be? What's our sweet spot? What's that top number need to be in order for us to be able to manage and make money? I'm going to flip over to another schedule here, and we're going to go into a little bit of detail here. Job schedule. This is a simplified job schedule. And can you guys see the numbers? Somewhat back there. Can you see any numbers or not? No? No? Yes? Okay. If you're looking at this job schedule, this is a very simplified job schedule. What does this job schedule tell you, or what do you take away from this job schedule just looking at it on face value? You've got 2 jobs that are uncompleted. You've got 2 jobs that are completed. The jobs that are completed were roughly around $95,000, $122,000 in total contract amount, each one. And they made 18% on the top one and 30% on the bottom one. Okay? Those are the ones that are done, completed, made good money. What about the bottom 2? You've got a $231,000 contract, which that single contract is more than both of those others combined. You also have a $400,000 contract. And what's your margins or your estimated profit on these jobs? It's less. Okay? In this case, in this scenario, you've got a $400,000 job. Your estimated cost to complete, or job costs, are going to be $390,000. You're estimating right now you're going to make $10,000 on a $400,000 job. I would imagine that you did not bid it that way. I imagine that you got partially into the job and said, we screwed up, we left something off of our bid, we've got to adjust our costs and our profit margin that we're looking at and make that adjustment on here. And if you realize that at this point in time, where you're only 25% into the job, I will guarantee you that job does not make money. It's very difficult to recoup costs at an early stage unless you know that. How many of you actually work off of a job schedule and WIP schedule? I would hope most of you do. Okay? This is key. And knowing early on where you're at on a job from a financial perspective, as well as your gut instinct. Your gut instinct says this job's going south because we're spending too much time on it. That makes sense. But when you look at it from a financial perspective and put it on paper, the numbers actually play out the same as what your gut tells you. So what do you do in a situation like this where you're 25% into it, you're planning on only making $10,000 on a $400,000 job? You better shift some people, right? You better shift some people out there, your best people, get that job done and get out of there. One of the keys to making money is being very proactive in responding on bad jobs. How many of you heard about the very, very large contractor over in Europe that went out of business? One of the largest contractors in the world. He's like second or third largest contractor over there. Completely went out of business. Why? 2 bad jobs in the same period. So all it takes is a couple of bad jobs and you're done. That's the risk that you take and the risk that you have in doing what you do. So the quicker that you can respond when things are going south, the better off you're going to be from a business standpoint. And you guys get that. I know you do. So I'm just repeating what you already know and are inherent. But putting it on paper and seeing it on paper and managing it by paper, by an accountant mindset, actually helps you understand that. What else do you take away from looking at this on paper? You need more work? If you only got 2 jobs? Yeah, you need more work. That's a good point. What else? This one's at BYU and this one's at the U. Does that tell you anything? The U can't make decisions? You're only making 10 grand at the U? Quit doing work at the U. Okay? Here's a thought. What if Jacobson's doing the work up at the U and you really want to do some more work at Jacobson, or you know that the U has a lot of work coming up, and so you're trying to buy work and buy your way in to do more work up at the U and do more work with Jacobson. Does that work in your business? Does buying work? No, it does not work. So for you younger folks in here, don't buy work. Utah is cheap. If you buy work, you will always buy work. If you bid a $400,000 job to make 10 grand, and you're willing to do that and not walk away, you're going to do a whole lot of $400,000 jobs to make 10 grand. It doesn't work in our economy and in our culture. Granted, we need to make investments. We need to make investments with the generals, and we need to make investments in those relationships with those generals. I would hope that those generals value you as a person, your morals, your ethics, your work ethic, and your trade, to basically want you on their job. This whole thing is screwed up in my mind. And again, I may derail here, but this whole bidding thing and basically lowest bid wins, it's screwed up in my mind. We need to get to a situation, and this is theoretical, but we need to get into a situation where we are that good at what we do that everybody wants to work with us rather than us wanting to work with them. We need to flip that table somewhere along the way. I don't know how we do it, but we've got to invest the time in the relationships. We've got to invest the time in the trade and in the quality of the work that we do. You know, how much value is there in the plumbing fixtures that end up in the bathroom down the hall here and that they work? Okay, not a lot of value in actually having that happen. But if you can do it in a timely manner, get in, get out, work well with others, and provide a value, maybe do some value engineering, some great ideas along the way, said, hey, have you thought about doing this? Invest in newer technology. Spend time doing research on what the next latest and greatest product out there is and implement that in your jobs. That's going to add value. So I think we've got to switch that just a little bit from where we're at right now, where we want to and we're willing to sacrifice dollars to work for certain generals and others. Okay? This right here tells me you need to find your sweet spot. And if there's one takeaway from today's discussion, it's find your sweet spot. Know what you do well. Know the type of work that you do well. Know the companies that you work well with. Let's say this one right here, BYU, maybe Jacobson, U of U, maybe Layton. And Layton beats the crap out of you because that's just how they are, and they're not fun to work with. And I hope they don't hear me say that on this video, because there are some good people at Layton, but generally they are a little tougher to work for. At least that's my understanding from the clients that I deal with. Again, it's project manager by project manager or project by project. But that said, if you do this type of an analysis and you consistently struggle or have lower margins with certain generals, what do? You focus on the generals that you make the most money with. You focus on the work that you make the most money with. If you do really good on hotels and doing the work at hotels, but you really haven't done well on schools, what do? Go after more hotels and don't do as many schools. It's not that hard. But looking at it on paper like this, you need to be able to see what do you do well with and where do you do well, and not just rely upon your gut. Okay? All right. Now we're going to dive into that next level, that next layer of accounting. And what do we do with indirect costs? I'm going to hand out or have somebody, you help me? If you'll hand one of those out to everybody. And then one of these as well. Wait, let me have one of those. I might need one. He's handing out a sheet that has a whole bunch of costs, direct costs, indirect costs, variable costs, costs that you incur in your business. And what I want to do for a minute is go through those costs and say, where do they go? Okay? Let's go back here. To your income statement. And I hope that this is more interactive as we go through this sheet, and I hope that you will raise your hand or voice out what your thought is. Some of these, there's not necessarily an easy answer. Did I run out of paper? Stud Row didn't get any? You'll have to share. All right. Dave told me there were only going to be a few of you. So there's a few more that showed up, apparently. All right. Okay, we're going to dive into these costs, and I'm looking at this schedule that shows all of these different equipment costs, or different costs that are incurred in your business. We're going to go through them real quick. Job materials. Where does job materials go? And I'm going to say above the line or below the line. And what I'm talking about is that a contract cost up here, or is it a general and administrative cost down below? It's above, right? That's a cost of goods sold. What about liability insurance? Below? Okay. What about rent for office? It's a below the line, right? That's an overhead cost. Yeah.
Why would you put liability insurance below? Because it's directly affected based on revenue.
Okay. Thank you. Can you easily identify it to one job, or is it something that then needs to be spread? Thank you. Appreciate that. Is that something that needs to be spread amongst all jobs?
Depends on how detailed you want to be, because ultimately it has a percentage basis of every dollar. So for me, I can actually break it all the way to every specific job.
Okay. So, the comment was that should be an above-the-line item because it is tied to your business, to what you're doing, to the work that you're doing. But it's not necessarily something that's tied to a specific job. It's something that should be spread amongst all of the jobs. Is that correct?
Yeah.
Okay.
It depends on how detailed your Excel sheet is.
Yeah. So here's where we're getting to, and I'm glad that you raised that point. There are those costs that would generally appear as possibly a direct cost, or excuse me, possibly an above-the-line job cost, but you can't isolate it to a specific job. So that then you have what's called direct and indirect costs. Direct costs are direct job costs. You can tie it directly to that specific job. But then you have indirect costs, which would be a project manager's time and salary. How do you allocate a project manager's time when they spread their time amongst 10 different jobs or 15 different jobs or however many jobs they're doing? You have to figure out, and depending on your complexity and how detailed you want to be, those indirect costs you have to kind of accumulate and pool them together and then allocate them back to the jobs based on some type of methodology. Oftentimes that methodology is based on labor hours. Sometimes it's based on revenue or size of the job. But there is a direct impact to this number right here, the more that you can shift up here. Okay? And I've got an example that we'll show here in just a second. So I would say liability insurance is a number, or is an expense that should be up here, probably isolated in this other, but it's a job-related expense. Does that make sense? Am I getting too detailed? Okay. What about utilities on the office? Is that a below the line? That's where I'd probably put that. Advertising, below the line. What about estimating supplies? Is that a below the line or above the line?
I think it's got to be below, because you get every job you estimate.
Okay. I've got a below the line up here because you don't get all of the jobs that you estimate, right? So it's a general expense that you're going to incur. Any other comments or thoughts?
Above the line.
Above the line.
If you have a job that's more complex, it takes more time to estimate than another one. You want to be able to tie that back into the job if you win it. If not, the loss can be put somewhere.
Yeah, and the comment there was, it's above the line because if you've got a complex job and you've got somebody that's spending a lot of time on the estimating side, and many of these jobs on a design-build scenario, you have to actually doing the design work as part of your estimating, that should get pushed back above the line to account for those costs, because otherwise they're just going to be costs that you're not going to recoup, right? Now, are you guys factoring in your overhead costs and estimating time and all of these indirect costs when you bid? I had a client, and I'm sharing this experience, just called me the other day. It was about 3 months ago. And he says something's wrong with how he bonuses his project managers based on the profitability of the jobs. And he said, when we bid the job, here's the spreadsheet that we go through to bid these jobs. And then at the end of the job, we calculate what the profit percentage was. And every time it's less than it ends up being less than what they had originally bid. Meaning they bid it to make 25%. They get to the end of the job, and after they allocate all the costs and they push back up the indirect costs, it only makes 18% or 17%. And he says, my project managers are pissed because they think I'm cheating them out of their bonus, but he says, I've got to account for these costs. And I said, the reality is, you're not accounting for them on your bid. You're accounting for them on the back end. You need to include your indirect costs and your overhead costs in your bid. And most people are too low on that number. Most people factor in a too low of a percentage when it comes to that overhead allocation or the indirect job costs being part of factored into your bid. What I mean by indirect job costs is what is your cost of labor? What is your cost of that labor hour? If you're paying somebody $20 an hour, what's their true cost to you? Is it more than that? How much more? Depends on how much fringe benefits you provide, but I would say it's probably in the neighborhood of almost double that. So when you factor in that labor cost, it's not the $20 an hour that you're paying, but it's more like a $40 an hour number that you factor in as a cost. But then you need to mark that up. So when you're bidding, my rule of thumb is you need to make 3 to 4 times the dollar amount that you're paying your people. Does that math work? Does that make sense to you? If you're paying somebody $20 an hour and you're bidding a job, you've got to bid it at $60 to $80 an hour on the revenue side to cover that cost and make a profit. Because somewhere along the line you've got to factor in that job isn't necessarily going to go as planned. Does that make sense? Do you guys do a lot of unit pricing? So much per foot, so much per yard? I wouldn't think you do a lot. I don't think. I've got concrete guys and tile guys and some other clients that do. My family, it was always fixed bid, and it wasn't necessarily per unit pricing. It was you priced out the job and there was this much dollars in it. You've got to, again, factor in these indirect costs. You've got to factor in job delays. You've got to factor in the inefficiencies. And if you don't, you're not going to make as much money. Project manager salary, above the line or below the line? Above. Should be above. But it's not directly tied to a job because most of them don't. It's an allocation item. Most project managers don't job cost their time directly. Do you guys do this in your business? Do you go through and allocate indirect costs above the line? I would hope that you do, and I'm going to go through now real quick a scenario right here that tells why this is important. Okay? Let's look at this scenario here. We have a $1 million contract amount. We have direct costs of $600,000, and then we have indirect costs of $300,000. Okay? Right here we have no indirect costs allocated to the job. We're planning to make $400,000. We still have that $300,000 of what's called general and administrative expenses that are going to be, in this case, below the line because we're not allocating it back to the job. And then you've got this scenario which says we got $300,000 worth of indirect costs related to that job. We're going to allocate it to that job, and we're at a net profit of $100,000, 10%. Okay? Simple math, simple numbers. Now we're going to go through the scenario and say, okay, year one, this is actual costs incurred in the performance of the contract. Year one, we incur $200,000 worth of costs, the direct costs. Year two is the $400,000 of the $600,000. Year one on the indirect costs incurred is $200,000, and year two is $100,000. So when we do our job cost schedule and we calculate what our percent complete is in order to calculate how much revenue we're going to recognize, it makes a difference on whether or not you allocate back your indirect costs. Let's go through the scenario. In this case, we're going to do no indirect costs are allocated. So it goes back to this top one right here. Right here, no indirect costs are allocated. So basically we're going to incur the $200,000 of direct costs. We're going to have $200,000 of below the line costs. So how much profit are we going to recognize on that job? If we look here, 200,000 is a percentage of 600,000 is what? 33%. So if we're going to recognize 33% of our costs, or we're 33% complete, how much revenue are we going to recognize of the million? 333,000, right? We take that percent complete multiplied by that number. Okay, so we take that number times 33%, it's 330,000 roughly. We're going to minus out our direct costs. That's this schedule right here. 333,000, which is 1/3 complete, minus the 200,000 of direct costs gets us down to a gross margin of 133,000. But then what do? We didn't allocate those indirect costs, so those are below the line costs that we're going to incur, and we're going to expense them in the year that they're incurred. So therefore, we're going to show a $67,000 loss on that job because we didn't allocate back our indirect costs. Year 2, we have 400,000 of direct costs and 100,000 of indirect costs. So now we're going to recognize the remaining amount of the costs. That job's going to be complete. We're going to then recognize the remaining amount of the revenue, and so we're going to have 267,000 of margin minus the 100,000 of the remaining indirect costs that are going to be below the line costs for 167,000. We still get to the same number, right? We still get to the same $100,000 profit. But from a financial perspective, we show a big loss one year and big income this year. Does that happen in your business? Do your financials look like that roller coaster? I believe they do. I believe most contractors that I deal with account for things this way. They don't push back the indirect costs to the above the line. Why does that make a difference? One, it makes a difference. Troy DeLuca is going to present after I'm done here in a little bit, and he's going to talk about what it looks like for bonding. They look at this and they say, you're losing money. Bank's going to look at that. They're going to say, you're losing money, or you don't know what you're doing. But then you have a big profit year. And then you go, geez, now I need to go buy a new truck. Right? That's what you do. So then you go spend the cash, and at the end of the day, you only made $100,000 on that job. It's just split between different periods. So here's the same scenario, same facts, same scenario, with the allocation of those costs to being above the line. If you take the $200,000 of direct costs and the $200,000 of indirect costs and you allocate them to above the line, what percent complete are you? 400,000 divided by the total cost, which was 900,000, is 44%. So you're going to recognize $444,000 of revenue minus your $400,000 worth of costs. You're going to recognize $44,000 worth of income. Okay? Year 2, we're going to recognize the remainder, which is 55.6%, and we're going to recognize $56,000 worth of income. This is a more consistent pattern or representation of your income. The only thing that's changed is you've allocated those below the line costs above the line. This looks better for banks. This looks better for bonding. Not many contractors actually go to this level and do this. This also affects your tax. Let's say you're on a percent complete basis for tax purposes until the law changed. Because now if you're less than 25 million, everybody's going to be on cash basis, right? So let's say you were in that $10 to $25 million range or above $10 million range for 2017. For tax purposes, you would have reported it exactly this way, right? You would have had a loss in one year and a bunch of income in the next year. How do you plan for that? How do you budget for that? Did you set money aside in this year because you didn't pay any tax so that you could then pay the tax in the following year? No. You went and bought a truck, right? You went and spent all the money you made over here. You didn't save anything over here because you had to use the money on the next job that you got. This is a better representation. It's better to plan for. It's better accounting. But again, most people don't do it. I'm going to have somebody pass this out. This is just an article to read in your own spare time. It's from 2004, I believe. It's from CFMA, which is Construction Financial Managers Association. It's really good on what is a job cost, goes into that direct and indirect costs, and talks about allocating those costs back above the line and methodologies there. It goes through this same exact example, but it really is a good read, and it's not too technical to be able to understand it from an accounting perspective. I'm going to wrap up in about the next few minutes here, and just want to kind of talk again about the key to making money in this business. We've talked a little bit about job costs, direct costs, indirect costs, what's included in cost of goods sold. Honestly, I don't care how you account for it on the back end. It doesn't matter to me whether you do this method or whether you do this method. I think the second method is better. But how much money do you make on this job under both scenarios? Same. 100 grand, right? We bid this job at $1 million to make 100 grand. How we account for it may be different, but at the end of the day, it's still 100 grand net. You better factor in your bid those indirect costs. You better factor in that overhead cost. I think most contractors don't do a very good job of factoring in those other costs. What do? We take our takeoffs, we look at the project, we look at the materials, we take the materials, we can account for those, we can make some phone calls, but we can price out the materials very easily. Then we say, oh, this is the type of work, this is how many man hours it's going to take. Here's our estimated rate per hour on that. Let's add a little bit for profit. That's our bid. I may be oversimplifying a little bit, but the materials, we know what that is. We may mark it up a little bit, but what is the biggest factor we have? Overhead, and then it's also, in my mind, labor multiplied by the hours. So our labor rate multiplied by the hours, and if we miss the hours of how long it's going to take to do that job, we've missed our bid. Does that make sense? So you got two factors. One, you've got to include the overhead costs. And you've got to include them before you mark it up. If you think you're going to make 25% on a job, but you didn't include your overhead, you're not going to make 25% on that job. So please include overhead when you do your analysis. That gets spread amongst all of your jobs, and you need to do a volume in order to cover that overhead, but that needs to be marked up. You need to make money on your overhead. That's not a giveaway or a freebie that you just say, well, that's my cost that I incur as a business owner. No. It costs you money to keep the lights on in that office that you sit in every day. And your customers need to pay you for that. That has to be factored in to your profit. Okay? Let's talk about labor. And I know I talked about this, I think last time I presented to you guys, we talked a little bit about labor, but I think that labor is the big variable. Getting good people to work hard and be efficient is the key to making money in this business. I think we're at a critical time in construction, personally. I think that in the 07, 08 time period, life was good. There was a lot of work. 08, market dropped, right? Kind of that 07, 08, we were at a peak and then it dropped. Once that drop hit, what happened? Some people got out. Some people went to South Dakota and got into oil and gas. Some people got out of the business altogether. Some people muscled through it. But in order to muscle through it, those that did had to get really cheap. You had to sharpen the pencil, and you had to basically say, okay, we're going to do work for near free. We're not going to make money on any of this. We're just going to survive this downturn in the economy and hope it comes back. There wasn't a lot of work out at that time, right? The volume of work went from here down to here. I think I've got a schedule with it. Let's look at it. Right here. This is volume. So the volume of work in Utah was right here in 07. Dropped a little bit in 08. 09 was here. 10, 11 started to come back. 12. You had a 5-year period of turnaround. That's a long time to float work when there's not that much work around. The volume right here was basically less than half of what it was here. Think about that for a minute. If over half of the work went away tomorrow, what do? It gets competitive, it gets tight, some people got out of the business, but we really got cheap. Well, my personal belief is that when we got cheap here, we haven't come back. The volume of work is there, but we are still bidding jobs at the same rates, for the most part, that we were bidding jobs here. I think the generals have pushed and pushed and pushed. I think owners have pushed and pushed and pushed. But I think right here, the volume of work is where it was. It's actually superseded the amount of work previously in the 07, 08 period in the peak. The volume of work is there, but our pricing structure isn't. Why? Because we're still bidding jobs using the same numbers and the same methodology here, for the most part. And that's where I talked about before. We've got to push back. Why are we making money right now? Why are we making money today in this business? Volume. We're doing more work, but we're doing it at higher costs. So what's happened since right here in the 09-10 period? Are materials the same price as they were 7 years ago? No. What about labor? Is your labor cost the same as it was even a year ago? No, it's higher. In some cases, even 40, 50% higher. Especially for those really good people that you want to keep around. So if revenues are flat, meaning your costs, or excuse me, your bid pricing and your pricing structure is flat, but your costs have been increasing, what's happening to your margins? They're being squozed, right? But there's enough work out there, and you guys are all doing twice as much work to make the money that you're making. There is a factor, though. You're actually doing it with less people. So from what I'm seeing from an accounting perspective, you're actually making profit because you're figuring out ways to be more efficient using less people because there's not enough people to do all of the work. But what happens when the volume goes away? You're going to be in trouble, okay? This is really what I see from an accounting perspective. This is what I see as a problem. If we don't raise our prices, as well as manage our people to continue to get more out of them with less people, we're learning how to work and do jobs and do work with less people. Some of us are doing less work because we don't have the people to go around. How many of you have turned down jobs because you just don't have the people to do it? Nearly everybody, okay? So we're learning to be selective on the work that we do the work that we can do well. We're finding that sweet spot, and that's a good thing. But we've got to continue to learn how to manage our people to make money in this business. Because that people shortage is not going to go away. And the volume of work may go away at some point in time, and things are good right now, but we need to plan for that. And the planning for that really takes place right now, where you say, hey, we've got to increase our margins. We've got to make more money on these jobs. We've got to maybe rethink the way that we bid. We've got to rethink the way that we interact with our generals. I was in a meeting yesterday with a subcontractor, and he said, I hate this game, and it really is a game, of change orders. You're out there on the job. The general says, hey, I need you to do this for me. Can you do this? He says, yeah, I could do that, but you need to sign this paper basically authorizing me to do that so that I can get paid later. It wasn't included in the bid. It's not efficient to not do it, right? Because if you don't do that work while your guys are there, the general's still going to want somebody else to come out and do it, and he's going to pull you off of another job at 2-3 weeks from now to turn around and say, okay, here you go. I need you to do this, and I'm willing to pay for this under a separate contract or a separate deal. Change orders happen all the time in our business, but how long does it take for you to get paid on your change order? Sometimes the end of the job. This contractor happens to be a concrete guy on the front end of the job. He gets strung out clear to the very end on change orders. It's not fair. It's not right. It's not good business. We've got to figure that out. And we've got to monetize that in a more efficient way. Again, I think that's been around since before my grandpa was born, and he's dead now. That's been part of how we play. But somewhere along the line, something's got to give. And from my perspective as just an accountant, I'm just a bean counter, that's one area that we really have to look at and develop the relationships with our generals to say, if I do this work, I want paid tomorrow. I'll do it for you. You're going to authorize it, but we're not going to wait till the end of the job to get paid on this because I'm out the cost of materials and people. And if you're going to make me wait till clear to the end of the job and go through the whole lien process and all the other stuff because I'm not going to clear it until I get paid, problem that you have is the general's not necessarily always getting paid on those change orders either. So they've got to go back to the owner to get the money to then pay you. Somewhere along the line, we've got to push back on that. That's a derail from the whole topic here, but that's just me up here saying, as an industry, things are good. There's enough work out there for everybody. I want you to make more money than you're making. I really do. I think you should make more money than you're making. The only way that's going to change is if all of you decide that you're worth more and you're not going to work for cheap. You're not going to take every job just because you're trying to squeeze every nickel and do every job. I think you're getting there. I think we're being more selective as a group in the work that we're doing. I think we're really finding that sweet spot and doing that analysis, and we have to, primarily because we just only have so many people to do that work. Thanks for having me here. I'll stick around for a little bit if there's questions and things that you want to talk about. Keep in mind that tax reform. Be proactive on that and implementing the changes to your business because that's effective today. 2018 planning starts today. And appreciate you having me here. Thank you.